Hey guys, this is Dawood with AutoMarketplace. Thanks for joining us again today. We haven't done one of these in a few months. And so today I just want to get right into it. We have a very specific topic to speak about, and that's Tesla EV NYC electric vehicle, EV NYC TLC comp and collision. And so what we're going to do is we're going to read an article that we wrote. We're going to try to keep this 30, 40 minutes. If we can do it shorter than that, great. I won't try to go longer than that. There's so many different aspects to this discussion. So what we're going to do is we're going to read the article that's kind of drafted up, and then we're going to embed this video that we're doing, which I think provides additional context because there's so much going on in the industry right now with all these EVs coming on, insurance, liability insurance rates increasing, and so comp and collision is a topic that probably needs to be discussed more, especially as it relates to EVs. And so I think we've gathered kind of enough information and we've done enough research where we think we can deliver a good piece of content about the industry. It won't be the last one. And then probably in another video, we'll cover TLC liability insurance, which is different. So let's get right into it. Okay, so the title of the article that will be published is Tesla and EV NYC TLC comp and collision is either unaffordable or impossible to get. Subheader. And by the way, all the links and everything is going to be provided. The only article we're going to read verbatim is this article, but it's a short article. So we're not going to read every single article verbatim, but this article we'll read verbatim just because it's short and it kind of overviews things. Comprehensive collision insurance insurer Adriatic doubles rate for TLC-plated Teslas as others stay away. Getting full coverage insurance for NYC for higher EVs is either unaffordable or impossible to get. Okay, so really quick, bullet points. Tesla and other electric vehicles, EVs, remain difficult for many NYC for hire transport, TLC comprehensive and collision insurance providers to underwrite. Kingstone, a leading TLC comp and collision insurer, no longer insures Teslas, but it does insure other EVs. Transit General, after briefly providing coverage for the Model 3 and Y, appears to have stopped. And I guess I should delete briefly because I'm not sure when they started, but after, I know they got very popular during the end of last year when everybody was buying Teslas and TLC plating them. So it said Transit General, after providing coverage for the Tesla's Model 3 and Y, appears to have stopped insuring Teslas used for NYC TLC work. Adriatic recently doubled its comp and collision rate to insure Teslas, and we'll share some details about that below. Many TLC drivers have auto loans that require comp and collision coverage, and the regulator, the Taxi and Limousine Commission (TLC), must take note and reflect costs in NYC driver minimum pay formula. And then the last bullet point is there's a video that we're doing right now included in this because there's so many things going on. And so I think sometimes it's important to speak to try to simplify it as best as possible and just provide all the context. But we're going to try to be as short and as simple and as succinct as possible. But this video might be 30, 40 minutes, but we'll try our best to get it there. Okay, so again, short article, let's get into it. Adriatic Insurance Company. Adriatic is one of a handful of insurance companies that provide comprehensive and collision insurance, and we'll describe that below what that exactly means. Coverage for vehicles in the NYC for hire transportation TLC market. Along with TLC liability insurance leaders American Transit and Hereford, which everybody kind of knows those names, Adriatic insure Transit General, and we've spoken to Dan at Insure, Transit General, and publicly listed Kingstone provide comp and collision coverage for NYC TLC drivers and fleets. TLC drivers and fleets often use the term full coverage to refer to comp and collision insurance. So what I mean, technically the term full coverage describes a driver having the required liability policy plus a comp and collision policy. So what I mean by that, just really briefly, is because it's like a terminology thing, but it's important, especially for people who might not appreciate the different terms, is oftentimes people say this term full coverage. And I think they often use the term full coverage to refer to just a comp and collision policy. What full coverage means is that it's a liability plus a comp and collision policy creating full coverage. So it's just a technicality, but sometimes people say full coverage and they're referring to a comp and collision policy. Based on our research that included speaking with several licensed TLC insurance brokers and studying recently written TLC common collision policy, Adriatic and Insurer appear to be the only insurance companies willing to underwrite comp and collision policy for TLC-plated Teslas. And it should be companies because insurer is an MJ, but it kind of works with insurance companies. And we have a podcast with Dan, and he explains that, and we'll provide a link to that too. And so why that's important is, as everybody kind of subjectively knows, but it's in the kind of facts as well, and we'll provide an update of this soon. TLC Tesla has a huge market share for electric vehicles in the TLC industry. And so if basically the comp and collision policies are either non-existent or so prohibitively expensive, that's a major problem that's kind of brewing. And that could kind of have an ugly side to it down the road. So here's a screenshot of Adriatic. We provide a link to the website, but they work with TLC insurance brokers, obviously, in New York City. So what is comp and collision? Just very quickly, we'll go over this. So comprehensive, or comp, covers damage to your vehicle from unexpected non-collision events like theft, animal damage, like a deer running into you, or running across the street and causing damage, a road, falling trees, weather damage. Collision covers damage to your vehicle that results from a collision with another vehicle or object. So that's comp and collision. So some of you might be wondering, if another driver's at fault and they kind of hit you, isn't their insurance company responsible for that? And so the answer is yes, their insurance is responsible for that, but sometimes that other driver might not have insurance, or the at fault determination is 50-50. Or in terms of the comprehensive side of stuff, sometimes another vehicle is not even involved, or maybe it's a hit and run, and unfortunately, that happens all the time in New York City, where you don't even know who hit you, but you were parked on the side of the street. So that's kind of the background of, what a situation where even if you get hit, why comp and collision is helpful. So if you finance or lease your vehicle, your lender often does require you to carry a comprehensive collision policy to protect their loan, i.e. owing more to your lender than your car is worth, known as an underwater auto loan. So obviously that makes sense. A lender needs to protect their downside risk with comp and collision insurance. Although many non-commercial NYC drivers have comp and collision insurance, NYC TLC drivers often just keep liability-only insurance policies for several reasons. Now, this might be confusing to some people because many people wonder, well, how is the auto loan provider even giving a loan or underwriting it? And we'll describe that in another article. We give the context to how that even comes about. Because if we're being honest, and just briefly on this, most dealerships and auto loan providers, they wouldn't, if they knew what if they actually did a intense underwriting, and it's not even that they're being lied to. Now, sometimes they exactly know what's going on, but they just want to sell a car. They just present the car to their finance department as a car for personal use, and normal regular DMV plates, not TLC or commercial for hire plates. And that's why the loans get approved. That's how they sell the cars. So it's not only a driver lying thing, which we'll get into later on. It's also like the dealer just wanting to sell cars, and kind of they just push it through, basically. So again, this is a short article. We're almost done with it, and then we'll provide context. It also doesn't help that comp and collision insurance this is what we're talking about, is prohibitively expensive for NYC TLC drivers due to the nature of insurance risk. And for some EVs, it's actually not even, for Teslas specifically, it's not even available, to buy without basically being prohibitively expensive or unavailable. And so we say this is hard to underwrite, due to the nature of insurance risk. And what we mean by that, it's prohibitively expensive, not because insurance companies are necessarily gouging. Maybe there are instances of that. But TLC insurance is hard to underwrite because think about, you're an insurance company and you're an actuary, which kind of basically the people who create and analyze and tweak the financial models, kind of simplifying that, of insurance companies to determine what prices should be. So imagine you're an actuary and you're saying, okay, what should we charge a driver that's driving a New York City vehicle 8 to 12 hours a day in New York City, in the five boroughs, out of the five boroughs, kind of, law pedestrians, bicyclists, a lot of stuff going on. It's tough insurance to underwrite. And so we won't kind of discuss that at length, but just want to conceptually make that point. Okay, kind of to the end of the article. Adriatic comp and collision is aggressive insurance, but you probably can't blame them. Before we share this video we're doing right now below, speaking about general and mostly NYC TLC comp and collision insurance dynamics, we think it's important to provide specific context. Below, we share a screenshot of a recent email that Adriatic sent to its TLC insurance broker partners. So Adriatic uses brokers to sell their insurance. So this is an actual email. This is a very recent email. Brokers sent this to us. Tesla rate, attention needed. Good morning. This from Adriatic. Please be advised that effective immediately, the rate for Tesla coverage for cars insured with Adriatic will be increased to 20%. Unfortunately, the loss experience has been very bad since the program began. Adriatic wants to keep the market available for Teslas, but it has to be profitable. We're hoping that this premium increase will help offset the severity of the losses, which will allow Adriatic to continue offering coverage for Teslas. Thank you. We'll get back to that. We also see below, a redacted screenshot of a recent Adriatic TLC comp and collision policy for a 2023 Tesla Model Y. Of particular note is the $5,000 deductible listed on the policy. Typically, an insurance deductible is $2,000 or less. Combining the $5,000 deductible with the disclosed premium increase to 20% of the value of the vehicle listed at $50,000 in the below policy. If anything were to occur during the course of the 1 year policy, a driver might be out of pocket over $5,000 to $15,000 before the insurance kicks in. Okay, so let me explain that quickly. Okay, so what this means, 20%, is usually how, from my understanding, and my discussions as well that confirm this understanding, is that, let's say so here, and this is obviously redacted for privacy's sake, the vehicle value is for the 2023 Model Y is $50,000. So what this 20% means is, in the first year of the policy, the premium is 20% of the value of the vehicle. So this is 10% of 50,000 is 5,000. So it's a $10,000 premium just for comp and collision, not liability, which, as we'll discuss in other articles and in another video we'll discuss at length, would be an additional 4 to 6 to 7 to 8,000, depending on your rate. So that's a lot. You're paying almost $1,000+ per month to cover your car. Now, this deductible, so that's a $10,000 premium, and then you have a deductible, fire, theft, collision, and combined additional coverage deductible of $5,000. So even if something were to occur and you've paid the $10,000 premium, there's a $5,000 deductible you have to come out of pocket for. And that's actually the $5,000 is a big deal, because many lenders, and we were talking about this earlier, and we'll talk about it later too, they require full coverage, but also in requiring the full coverage, they also require like a one, maybe they'll accept 2,000, but definitely not 5,000, because they're like, well, what if the driver doesn't have 5,000? Then we're on the hook. It's not covering our downside. So $5,000 deductible plus a $10,000 premium for the first year. And the loss payer here is a credit union. So a credit union provided this particular loan. That's just, it's insurance, but I mean, let's say an accident happens 9 months into the policy, and you've paid the full $10,000 premium, and a deductible is 5,000. I mean, it's just tough. Like, a lot of people don't have $10,000 or $15,000, lying around to pay out of pocket, and then the insurance kicks in, if that makes sense. We'll provide a link to all of these things. So Nationwide defines collision and comp, if you want to check that from another definition. So the first article we start with, we're not going to read all of these articles verbatim, but it just provides the necessary context. And if people want to, explore our content for these articles, and also we have YouTube videos that overview this. So in April of 2023, so almost a year ago, there was this very interesting situation. There was this very interesting situation where a gentleman called Damon, I think his name was Damon Sturdivant. Yeah, he kind of used a TLC hearing that was related to something else to talk about how he couldn't get comp and collision for his Tesla Model X, which is, for those who know cars, a Model X is more, you know, 70, 80 plus $1,000, and Model S is also of that cost. So there was zero options. Like, so Adriatic, or I guess Insure wouldn't insure like a luxury Tesla, basically. Although I do know Kingstone, funnily enough, is insuring luxury non-Tesla EVs, but that could change. So in this article, that's an interesting clip. And the other thing we wanted to highlight was the actual backdrop to when Kingstone decided to stop providing comp and collision coverage for Teslas. And that happened kind of in April and May. And it says, we are writing, not too similar from Adriatic, but Adriatic just kind of increased the premium to like 20%, while Kingstone determined that even if Kingstone probably determined that, okay, if we needed to make this work, we'd have to increase it to that, but no one's going to buy the insurance. So they said, we're writing to inform you that Kingstone will no longer be accepting Tesla vehicles into our programs. The change is due to poor loss experience for vehicle type. So you're noticing a trend. Adriatic is saying poor loss experience. Kingstone is saying poor loss experience. Any quotes started on before April 21st that include Tesla 2023 will be honored if bound before May 2023. After May 3rd, we will not honor any new business that includes a Tesla vehicle. And so there's other stuff in this article, but that was done on April 20th. Okay. Now, let's kind of address what's driving like a horrible experience for insurers when it comes to Teslas. So we want to point to a couple of articles and a couple of instances to kind of hint at what's occurring. So August 18th, 2023, again, all the links will be provided. So we did this article that covered many things, but I think this is particularly relevant. Here we basically, and this is with a Rivian, not even a Tesla. So I think it's an interesting point to be made is Tesla, out of all EVs, Tesla actually might end up being the easiest to provide comp and collision to, because imagine like a Rivian or a Lucid, like they haven't built out any third-party network at all. Tesla might have like a nascent network at the very least. And so in this example, for the $42,000 fender bender, it's like I think the example is that a Rivian gets rear-ended and it costs this insane amount of money because there's like, only a handful of technicians or mechanics who can even work on a Rivian. Just think about that. That's like a very interesting issue. Like, if who can even work on the Rivian or order the parts of a Rivian, who is a certified shop. And so in one of the articles, it says the $42,000 repair cost, along with the driver's rental car cost, was very close to maxing out the other driver's $50,000 insurance payout. So from an insurer's perspective, think about that. They're thinking, okay, fender bender, if this happened to a gas car or a hybrid car, our historical actuarial assumptions would have implied that this is like, 3, 5, 10,000 at most payout. Now it's 5x that. So our actuarial model is going haywire. We need to underwrite. We need to reanalyze how we're underwriting this. So that's kind of the main topic as it relates to this topic in this article, but we talk about other stuff in this article. Then I also wanted to point that there's a company that we were following called Drive Sally. Many of you might know that name. It's like a fleet company. They do yellow cabs as well. And in a tweet, so they very famously, I think, were either the or one of the very first Tesla adopters for yellow cabs. And so if you go to their X profile, this is all obviously publicly available, formerly known as Twitter, obviously. If you go to their profile, if you scroll down, I remember this at the time, actually, that Yes, here's the incident. So January 26, 2021, it says, let's see how quickly we can get her back on the road. Backup EVs have been deployed. So now, I mean, an obvious point I want to make is like a fleet can afford a backup as obviously they, responsibly are running their fleet and it's a bigger fleet. An individual cannot just have a backup TLC car. No one can afford that. It's not practical. So I just want to make that point. But besides that point, let's just follow along. So January 26th, this happens. So let's follow along. So January 27th, always have a backup. Then, okay, February 3rd. So January 26th, February 3rd, like let's say a little more than a week has passed. It says, or okay, T plus 9 days, 9 days of S. Delamination complete, parts order, let's move faster. So I don't know if they're at Tesla NYs, or maybe they're frustrated, or maybe they're just saying like pumped up and say, let's move faster. But like, honestly, like this is like quarter panel damage, bumper damage. But if this happened to a Camry, like this would have been repaired based on at least the visual. We have experience in this based on just the visual of this. This doesn't seem horrible from this angle, at least. So anyways, February 3rd, and excuse me, February 3rd. So February 10th. So okay, this was February 3rd was T plus 9 days. Now we're on February 10th. So that's T plus 16 days. New subframe in, unexpected damage exposed during teardown. That just sounds nightmarish, whatever that means. But there's basically, they got the parts, and I guess when they opened it up, there's even more damage. And that says now we're mobile. And then it got fixed at some point. But it's kind of like, it's an interesting, very specific example. So if you want kind of to follow this account, it's at Drive Sally and it's on X, a very cool account. So okay, so now this article I spent a little bit of time with, but I'll try to go over quickly. I think the point here, what I'm trying to make is, I'm trying to explain, how does, number one, some people might seem to be like, why are you sharing this information, drivers and fleets? But at the end of the day, this truth is going to come out with, and it's going to be triggered the by EVs getting totaled, not because EVs are bad, just because cars get totaled, and physical damage caused. And this will become a story, and it's already becoming a story, as you've previously seen. And the reason why, what I'm trying to do here, I'll get to the point, is that how does a TLC driver fleet t- manage to TLC plate a car without physical, uh, without comprehensive and collision insurance, because the insurer wouldn't provide them a loan if they didn't see the record of that, if that makes sense. So here I provide an explanation, because I know this market very well and I know how it works. And this article is from October 27th of last year. So generally how it works is that a TLC licensed driver will go to a dealership and portray they're buying an EV for personal purposes and present regular non-commercial DMV insurance documents, State Farm, Progressive, Geico, Allstate, et cetera, et cetera. I just want to make a point, and I made this earlier in kind of the top of the video, is that oftentimes it's not just the driver who's doing that. Like the dealer, especially in a New York City based dealer, they exactly, for the most part, knows what is going on. The finance manager knows what's going on. But the underwriting of the loan is occurring on like a national level. Like the underwriting might be in Ohio or Delaware or Maryland or Texas or California. So they just might want to sell the car. And because historically this comp and collision thing, you like, drivers could always repair it out of pocket and figure it out, or the loss runs related to comp and collision weren't that bad. They kind of got away with it, if you will, and the driver sold the car, they made money on the financing, and everybody was happy. No one got hurt, if you will, except I guess a few people. But obviously, if the lender knew the exact truth uh, up front, they're not going to write that loan. There's not a chance. And so I think anybody who has a finance background or a banking background will tell you that. So in any case, if they pass the credit check, they'll be approved for a loan and have access to the applicable warranties. That's actually, we won't dwell on that, but a warranty is a kind of a type of insurance. So like for EVs, the battery warrant is like really important because battery replacement is like a major expense. Like if something happens to the battery, like 5, 10, 15, $20,000, and then you need to find someone to do it even. So it's very complicated. So there's also this other question like about, does a battery warranty get voided? Like Rick Rebuilds, a very famous kind of guy who's been reviewing Teslas, like buying them salvage and stuff. I remember one of his videos one time he had mentioned that like someone's battery warranty was voided because they're using it commercially, the Tesla. Anyway, something to note, but we won't dwell on the warranty point in this video. You guys remember the dealer and lender sees a standard policy and are generally satisfied. The TLC licensed driver drives off the lot with the new car, picks it up later with a non-commercial New York State DMV plate. So the dealer sees basically the dealer because remember the dealer kind of sometimes knows what's going on, but let's say the lender sees normal, everything checks out. Guy has good credit or acceptable credit. He has a home address, et cetera, in the New York City area. He has New York auto insurance from Geico. They do the DMV registration. They get a quote unquote normal, non-commercial DMV plate, right? So it seems like everything's standard. After this, what happens basically is a TLC driver goes to, or a fleet for that matter, but it's obviously vast majority of the market is TLC owner operators, goes to their NYC TLC insurance brokers and gets a commercial TLC liability policy. So then once they get that commercial liability policy, they can complete the TLC plate process. But in order to do that, they cancel their DMV regular full coverage insurance policy, and then they hand in their normal DMV plate. But the lender often doesn't check back in on, is this car, number one, still have a regular DMV plate, and is it being commercially used, and is there full coverage? Because by the way, they would probably just cancel the loan on the fact that it's being commercially used, but that's what happens. So basically anyways, the net result of this is you have a auto loan on any car, but in this instance, an electric vehicle, or I guess any TLC plated car. But the point of our article is talking about the lack of full coverage for electric vehicles, especially Teslas. This is how the situation arises, where you have an auto loan on an NYC for hire vehicle, TLC plated vehicle, that does not have full coverage but has an auto loan. That does not have comp and collision, I should say, and has an auto loan. So, and then we talk about, how some insurance companies and dealers probably know that's going on. We reference our Kingstone article. So that's October 27th. Okay, and we'll get back to this article. And then just a couple more on this topic, and then we'll kind of wrap the physical damage discussion up. And then very briefly mention the TLC insurance market in general, but we'll do a separate video for that too, because there's just too much to discuss there. So we did a recent video, and other media outlets did a recent video about the Hertz CEO stepping down, resigning, and a lot of blamed it for kind of like an EV bet gone bad. Hertz very famously, and you can kind of see it via the stock chart, had all these EV announcements with Tesla, with Uber, with Polestar, with GM, electrification goals. Even with the city of New York, they had one. And obviously, the share price performance tells the story of that. And then also just the financial results, there were some major markdowns. And so, without reading the entire article, I think let me read this paragraph and then explain it. It says, Hertz's big EV bet gone wrong is a good case study for regulators, drivers, and fleets to take note of. The lesson isn't that EVs will not be adopted over time. Again, this is not an anti-EV podcast or article. And AutoMarketplace actually we view this as a big opportunity. So I just want to make this clear. This is just talking about finance and math and like just kind of news about this. Anyway, sorry. will not be. So the lesson isn't that EVs will not be adopted over time. The lesson is that this isn't a one-off on-off switch, and the financial math is brutally non-partisan, non-political. If Hertz, a giant rental company with a genuine expertise in running vehicles and fleet management, miscalculated the operational cost of EVs, perhaps we should all adjust our assumptions about whether individual NYC TLC drivers who have significantly less financial resources can make EV math currently work. So if you kind of read the article and you get into the details, two things that Hertz basically flag about what was hard about EVs is three things. One is renting them out to Uber and Lyft drivers who kind of drive them, surprise surprise, drive them into the ground, and that's Uber and Lyft drivers outside of New York City. Like New York City is Uber and Lyft on steroids in terms of what cars go through. The another thing that they mentioned is that the depreciation on EVs. So like when you run a rental company, or if you're Hertz, think about it. You buy a car, let's say at a wholesale price from Tesla, like let's say you buy a Model 3 or a Model Y at, let's say a Model Y at 40,000, like because they're buying like 50,000, they get a wholesale price. And then you're assuming a depreciation schedule to set the rental rate. If the depreciation starts going haywire because there's an excess amount of EVs or the demand changed, then your depreciation math gets all messed up. And then the rent and what you recognize the value of the car on like your balance sheet is incorrect. And there's all this kind of write downs have to occur. It's not too dissimilar from like a bank assuming a loan will be paid off and then the guy defaults and then they have to write down the loan. Anyways, so that's another reason, the depreciation of EVs, which also basically implies that you're kind of overpaying maybe for comp and collision if they don't have a proper depreciation schedule. And then another thing is repairs on EVs, like the lack of a robust third-party service network and all of that stuff. Now, all of these things will be figured out, but even a gigantic company like Hertz was having trouble with it. So you can imagine, an individual, if you will. And so going back to this article very briefly, I should mention that Transit General, so basically, without rehashing this whole history, very quickly. So basically, on October 18th, and a lot of our subscribers know this, they opened up, they reinstituted the EV exemption to the TLC plate cap. So basically, if you bought an EV, whether you're an individual or a corporation or a fleet, you could get a TLC plate. And this was like the first time this occurred since, a few years, like 2021. But in reality, EVs became affordable and everything. It's really the first time like people are able to get like a non-wheelchair accessible a TLC plate for a non-wheelchair accessible vehicle in New York City since like the summer of 2018. In reality, although the EV exemption existed, but like EVs were expensive, a pandemic was going on. So, anyways, that caused a rush when that was open, and then a lawsuit basically subsequently ensued that's still being litigated. So from October 18th to like November 13th, I think was the date, almost 10,000 EVs were bought for the TLC industry. That's not even, you didn't hear that wrong. 10,000 EVs were bought, almost like 9,700 something. So Transit General, and this chart was just about like previous to that announcement, like it just kind of underlies like the market share of Tesla. Like earlier in March, they released 1,000, and as they were getting distributed, it's clear that the Model Y and Model 3 had the majority share of NYC TLC industry. So there is a company called Transit General who was underwriting, who were basically kind of came out of the blue or wasn't that well known before, and a lot of drivers who wanted full coverage or comp and collision coverage, I should say, started hearing of this company, and they started and they're an admitted New York carrier as well, but they started underwriting comp and collision for Teslas. And so we got a screenshot from a driver of one of them, or a broker or driver, I forget which one. And so 2023 Tesla Model 3, you can see stated value. It's cheaper than the Model Y. The Model Y was 50,000 in that Adriatic insurance policy. Here it's 39,000, let's call it 40,000 for the sake of simplicity. And then it costs for comp and collision, they break it up. it costs $2,750, so roughly 6 to 8, 7%, 6 to 8%. So remember, Adriatic says we're increasing it to 20%. This is more typical of a comp and collision policy in TLC, like a 6 to 8%. Like on the first year value is 6 to 8%, and then there's a depreciation schedule. So basically, after the first year, if they still want to continue the policy, then let's say here it says after 1 year, there's a 25% depreciation. So for simplicity's sake, let's say the stated value is 40,000. So if it depreciated by 25%, that's 10,000. So then it'd be like 7% on 40,000 would be the new policy premium, and so on and so forth. So Transit General now has stopped. We've confirmed that. And if any broker has heard otherwise, please let us know or comment in the video below. But so Transit General has now stopped. So a lot of people were saying, isn't Transit General underwriting it? So kind of to wrap this up, there's one more point I want to make in terms of a technical point, and that's about driver pay in how it relates to comp and collision, and why the regulator, the TLC, needs to understand why this is so important. So we did 2 recent articles. We're not going to go over them in this video, but they basically were like kind of big insurance overview articles for, the renewal season this year just wrapped up. February 16th, we did part 1, and February 28th, we did part 2. And in these articles, we were mostly talking about liability insurance. Now, that's the actual required insurance and how much it's increased. It's increased 10 to 30%. We also highlight two, it's on our YouTube channel and also embedded in this article, 2 discussions with Insurer's co-founder and CEO Dan Bratchup, great discussion, and Next Century, which is a really good TLC insurance broker, Gavril Gavrilov. And by the way, in that discussion, I think Gavril mistakenly, it was a slip of tongue, said that Transit General was not admitted, but it is admitted. So I just want to put that for the record, but it was just a slip of tongue. But the discussion is very good regardless. So that's more about liability, and there's just so much to talk about, and loss runs and things like that. That's for another video. But you can find the videos here. You can also find them on our YouTube channel. If you go to as a short way insurance, here's the videos. You can find it there. But basically, insurance. So this is why I mentioned, and then there's another thing going on where American Transit, which has like a 60% share of the liability insurance market, also is a player in the comp and collision market. They're being sued. There's questions, not our questions, but kind of questions from actuaries about their solvency, meaning like, are they like a viable insurance company? Can they play out their projected claims or future claims? And if they can't, then, that's, they can't basically be an insurance company in New York State. And so basically the main point of these 2 articles is that insurance costs for liability have gone up 10 to 30% plus, right? Now, comp and collision with EVs, effectively like for like, if it's basically unavailable, then there's not even a comp to it. But let's say you comp it to last year, comp and collision policies, you just saw it in Adriatic's disclosure. Like this inflation, if it increased from 20% to 10%, inflation of that's 2x inflation. That's 100% inflation. The thing doubled. So, liability insurance is up 10, 30%. Comp and collision insurance is, in this instance, up, 100%. The deductible, by the way, is up 5x, so how does this relate to that driver, this thing? So every year, the TLC recently sent a mass email about this. The TLC adjusts the driver minimum pay for inflation, and they use this inflation index, get to it, called the CPIW inflation. And CPIW is designed to measure changes faced by urban wage earners and clerical workers. and it's for New York, Newark, Jersey City, tri-state area, basically. And so this year, the inflation increase was 3.5%. Now, let's not come. Many markets don't even have an inflation increase, so it's really good of the TLC to even put an inflation increase, embed an inflation increase in the TLC driver minimum pay formula. With the TLC driver minimum pay, is it basically is a mechanism to ensure that drivers working in New York City for Uber and Lyft get a fair wage and that they're kept busy. They don't want idle drivers, basically idle drivers and idle cars and people like earning below minimum wage in New York City, doing commercial for hire work, which is a licensed job and historically was a middle class job. So the point I'm making here with comp and collision and liability insurance is that clearly 3.5% is not reflective of the insurance increase. And then it reasons that if insurance is basically, if insurance is a major expense for a driver and a fleet, which it is, major meaning it's like a major business, like 15, 20, 25% plus business expense of a driver or a fleet, and you're increasing the wage by 3.5%, it's just the inflation index is clearly not representative of actual inflation being experienced by drivers and fleets in New York City. So that needs to be assessed. And uh, I think the regulator, the chair, David Doe, recently discussed maybe reanalyzing that. But I think I just want to quantify it more with insurance and how that's not being really reflected in this. Like if a man's t-shirt, if a man's like if the cost of potato, I'm not sure if that's included, but if the cost of like a t-shirt has gone down by 5% and that's kind of dragging down the inflation index, that's not really reflective. Or if the cost of regular insurance, although that's gone way up, has gone up 10%, even that's not reflective of what's happening in commercial liability in New York City. And so I just want to make the point. So basically, the last point I'll make on that minimum pay thing is that if Uber does accurately, let's say the inflation adjustment is 15%. Another thing you have to think about, and we'll talk about this in another video when we focus on that topic, is that if instead of, let's say, effectively a $27.70 gross minimum wage you're trying to solve for on keeping someone busy more than 50% of the time, if you're trying to solve for $40 an hour gross wage, which honestly is probably the wage that needs to be middle class in New York City, honestly, probably even higher, but let's say it's $40, that's going to have other downstream impacts and other impacts where if Uber and Lyft have to pay a $40 gross wage, they only can have so many drivers, and like almost overnight, active drivers would probably ask to join an Uber planner or get kicked off, or lockouts would come back, which we wrote about recently, but we'll talk about more at length. So that's something else to layer on. In any case, we'll end there. We'll embed this video we just did. Thanks a lot for taking the time and listening. But we thought there's a really important dynamic that's going on, specifically as it relates to EVs and comp and collision. And we'll make more content about TLC insurance and other dynamics going on. So we hope you enjoyed this. Let us know if we got anything wrong. Let us know your comments below. Subscribe to the newsletter. We'll put all the links to all these various links and Drive Sally's Twitter thing. We'll also provide a link to that in the description. And so thanks a lot for the time and appreciate it.